Hi, Hunter Hastings here. Are the big tech corporations of today malign or benign? Maleficent or beneficent? Evil or good? Well, we live in the age of quantum physics, which tells us that both of those conditions can apply at the same time. Light can perform as a particle, it can perform as a wave. Both are true. It depends on the observer. The same is true then with corporations. They're both good and bad. The problem is that there's a tendency for the bad to become worse and the good to get more and more suppressed and pushed into the background.
This is the Value Creators Podcast. Value creation is the sole purpose of any business and every business, and for all of us as entrepreneurs. Listen to great value creators as they share their successes, trials, and lessons learned. Join us as we explore how to think as value creators, how to act as value creators, and how to view business through the lens of value creation.
My colleague Steve Denning and I decided to do some research on this, and we've just published a book about that research. It's called Aberrant Capitalism. The premise is that corporations started out back in the 19th century as a wholly positive contribution to individual economics. They made people's lives better. They disseminated the new technologies of the second industrial age with railways and steam and electricity and transportation and education, nutrition and health in a great way that supported lives all over the world and made them better. In the 20th century, however, the entropy set in. Corporations became increasingly centralized, bureaucratized, financialized, and entangled with government. All bad things. And so by the end of the 20th century, we should worry about the state of those corporations. Will they get better in the 21st centuries in the new digital age? Well, the jury is out. But I asked my colleague Elias Monroy to conduct this interview to explain what our point of view is in the book Aberrant Capitalism.
Hello, Hunter. Welcome to this special edition of the Value Creators Podcast.
Thanks, Elias. It's strange for me to be in the interviewee seat, but we have a good purpose for that today.
Today, we're going to talk about your latest book from the Cambridge University Press titled Aberrant Capitalism, The Decline and Revival of Customer Capitalism. My first question for you is, why did you write it?
Well, the title Aberrant Capitalism, Elias, is intending to imply that we have an ideal of capitalism, that we have a high standard of capitalism that was established in the past, but some things have gone wrong. And today, the problem is that young people are critical of capitalism. There's a Pew Research poll from 2022 that shows that only 40% of young people, 18 to 29, had a positive view of capitalism. So a majority did not. They had a negative view. And that's much worse than the response from 65-year-olds like me. And so if we lose confidence in capitalism, if we lose young people's confidence in capitalism, then we may lose the institution. So that is very troubling because capitalism is the economic system that has raised living standards and quality of life for billions of people over hundreds of years across the globe. And if we lose it, then we're at risk of losing all that economic progress, indeed losing civilization. So that's the first reason. The second reason is trying to understand why those young people are criticizing capitalism. And the analysis shows that really they're criticizing corporations, the behavior of corporations. I say that because when you think about it, they criticize income gaps. And it's corporations who pay the salaries and set the wage rates for people. They criticize wealth gaps. And it's institutions like corporations who issue the stock and trade the stock and create the bonds that constitute the kind of wealth that's in individual hands. So the wealth gap can be attributed to corporations. they criticize dehumanization of work. It's work is automated and workers aren't treated properly. Well, that's a criticism of corporations. And they criticize things like degradation of the environment, and that's the waste and externalities of corporations. So really, they're not criticizing capitalism; they're criticizing corporations. And so we wondered why that was the case, and we did our research, and that's the book, Aberrant Capitalism.
That's very interesting. You cover a lot of historical ground in explaining how corporations went from what you call a customer capitalism to a distorted managerial and financialized capitalism. Can you take me through the journey?
Yeah, it's an interesting journey. So we try to go back in time, all the way back to the 18th century. So you think about Adam Smith, who's the economist who's often thought about as kind of the father of capitalism. But we also looked at companies back then. One of the ones we studied was a famous British company. It's called Wedgwood and Bentley. It's usually known for its Wedgwood crockery. And that was a super innovative company. It was producing pottery and crockery for all kinds of segments of the market, from royalty to rural farm workers. Lots of innovation, lots of great marketing. They kind of invented the brand name, putting their brand name on this crockery. They added new functionality, the kinds of bowls that you need for the newfangled spoons that were out there at the time. So lots of innovation, production innovation, new techniques, new glazes, new colors. And all of it was directed towards improving people's lives. So that's what we called customer capitalism. The view was always external. What does the customer want? What's happening in their lives? How can we improve that? And so that was the essence of capitalism. It was for customers. Now, Wedgwood and Bentley was a partnership, which was the typical setup of the time. It was a couple of people with their own money. There was no stock market. They didn't issue any stock. They used cash flow to generate the new production equipment and the new production lines and the new marketing and the new retail displays that they could set up. And so it was all customer oriented, driven by cash flow, and not financialized or organized in any way. But they couldn't get big. They couldn't scale from that position. They sold crockery all over Europe, but it was never what you'd call a big business. But that was the start. That's where we began.
So how do they go from being stuck at that scale to mass production? What was the breakthrough?
Yeah, it's really interesting. And we think the breakthrough was a legal one, an organizational one, which was the creation of the limited liability corporation. So before that rule came into place, there were very stringent bankruptcy laws about if you went bankrupt, you'd go to jail. It was typically the case. And so people were very scared about investing in other people's businesses because of that risk. And in the 1850s, roughly speaking, there were a couple of legal breakthroughs they could in the UK, but they became most enthusiastically adopted in the US for the limited liability corporation. So then the corporation could attract multiple investors, could develop more capital, could increase its scale. And that's what led to ultimately mass production, mass distribution, mass merchandising of some of the great companies of the 19th century, which we'll talk about. So still oriented towards the customer, but now being able to reach more customers in more places with more products and better service.
So you talk about this as the era of the beginning of customer capitalism, right? What exactly are you getting at with that term?
So think about the second half of the 19th century. There's huge breakthroughs in technology, the second industrial revolution. So we're talking about the railways, roads, the refraction of oil, which produced kerosene and eventually petroleum. At the end of the 19th century, you got electricity and communication and health and nutrition. All of these new technologies were growing up, and new corporations were able to capitalize on that, i.e., build the factories, build the railways, and build the production facilities that could deliver the benefits of all of these new technologies to more and more people. And this is the time when America's moving westwards. The population's increasing in Europe. There's more and more customers spread out over more and more geography. They got more and more new needs because they're creating townships, they're creating their own businesses, they're growing manufacturing production. And so these corporations served that burgeoning population, and they improved their lives. They gave them light, and they gave them heat, and they gave them communication, they gave them transportation, they gave them safer food, they gave them better clothes, they gave them sewing machines, which helped them to make their own clothes. It was just a cornucopia of customer benefits. So that's why we say it's customer capitalism. The customer was deciding what they needed in this great new world.
So tell me, Hunter, hasn't there been criticism of big companies of the 19th century as robber barons, exploiters of the economy, gouging customers, suppressing competition, and generally behaving in unethical ways?
Yeah, that's one of the great myths and great negatives of our understanding of capitalism, Elias. So here we have these owner entrepreneurs. They were individuals using their own capital, entrepreneurs in the sense of building their own companies, serving customers. They've got what we call the entrepreneurial ethic, the desire to serve these markets and gather the reward that the market gives them. John D. Rockefeller is the one of the examples that I think he was the first one to be called a robber baron. So he developed a company called Standard Oil, and it was technologically very, very advanced. You're digging oil out of the earth and you're refining it in ways that the end product back then was kerosene, which people burned in lamps. Candles were very, very expensive at the time. And so candles were not available to a lot of people living in the rural parts of America and living in the West. And so he extended the period in which these people could work, could teach their kids, could have family time, because it was affordable illumination for their houses. And so he's typical of this customer-oriented entrepreneurial capitalism. Another one in the book is Quaker Oats. And Henry Crowell, who is the owner-entrepreneur of Quaker Oats, developed safe, nutritious packaged food, oats that he had refined and made into a product that could easily ship, the packages that kept it protected compared to what went before, which was just out of barrels in the general store, which might have been vermin infested or not very sanitary in any way. So he was another one who created a lot of consumer value. Carnegie in the steel industry, he developed lower and lower costs for better and better quality steel. So this compounding improvement for customers. And it was a journalist called Ida Tarbell who coined the term robber barons, because her father had been one of the inefficient producers in the oil industry that Rockefeller effectively put out of business because he was creating a better oil company. So she was resentful about that. But the name stuck. But historian Paul Johnson wrote that we should call them the prospering fathers, as opposed to the founding fathers who wrote the Constitution. These were the entrepreneurial fathers who created customer capitalism. So robber barons is a really unfortunate term that is stuck, but it's absolutely wrong about the 19th century entrepreneurs.
So based on what you're saying, the 19th century gave the 20th century this economy of big, efficient, value-creating companies, driving economic growth, improving lives, lowering prices. Did something change since then?
Yeah, something big changed. And the first step, Elias, was the entrepreneurs exited and managers came in. And that's a big pivot point in the book. In fact, our opening quote is from economist Ludwig von Mises, who said that the capitalist system is entrepreneurial, not managerial. So what does that mean? Entrepreneurship's a technical economic term, and the way he's using it doesn't mean just startup businesses. He means the external-oriented, market-facing capitalist who looks to see what consumers need and then develops a capability of fulfilling those needs. So we've talked about a lot of the entrepreneurs. Another one to think about is Richard Sears of Sears and Roebuck, and people listening in the U.S. might remember that Sears Roebuck was the Amazon of its time. It was the great catalog that was mailed out to everybody, and you could order anything and everything in a Sears Roebuck catalog. It'd be shipped to you, not in one day. It might take a couple of weeks back then, but everything was available. And that was farmers buying equipment. It was homemakers buying devices. It was watch sellers and watch buyers. It was all kinds of products constantly being improved, constantly being lowered in price, constantly being shipped at a faster and faster pace. So these were the entrepreneurial activities. Managers came in to help run the factories and make things efficient. And what we have to observe there is that managers have a different orientation. I mentioned the external orientation of entrepreneurs, looking to the market, looking to customers. Managers look internally. They look at the machines, they look at the processes, they look at the people. They say, how can I make it more efficient? How can I reduce labor costs? How can I improve the supply chain? How can I make shipping more effective? And so that internal orientation is the big switch. So they have different goals than the entrepreneurs. And so this switch, this let's look internal and make the machine work better, as opposed to let's look internal and make the customers' lives better, that became what we call the entropy, the kind of grinding change that shifted from customer capitalism to managerial capitalism. It's a big change.
It feels like it. But what exactly do you mean, Hunter? Can you tell me how the objectives of entrepreneurship and management are different?
Yeah, it's really fundamental. It's the entrepreneurial wish to improve customers' lives. And that's the driving force. That's the energy. It's what makes entrepreneurs tick. It's the spirit of capitalism. And when we want to think of capitalism as the great force that raised the quality of life and the standard of living so much, as I said at the beginning, over hundreds of years across all countries, across billions of people, that's the entrepreneurial orientation. And then management is about processes and methods. It's about lowering costs, not for the customer, but for the company. And the difference between this internal orientation and external orientation creates a tension between management and entrepreneurship. And in the 20th century, corporations have all been about management. That's what business schools teach. It's what the business press writes about. It's what books are written about. It's about management. And so this is a fundamental difference. We've lost the entrepreneurial ethic and replaced it with managerial efficiency.
And according to your book, in addition to all of this, there was another development that intensified the tension, right? And added this dominance of management over entrepreneurship.
Yeah, so it's really an interesting development of management, and that was in war. And we were thinking, especially in this book, about the First World War and the Second World War. And the government, having got itself involved in a war, decides that it needs to manage, it needs to focus production. We need more tanks and more ships and more uniforms, more guns, more bullets. And they use management techniques to make that possible. They created plans, they allocated resources, they told people what to produce. They set prices. They addressed scarcity by shifting resources from one factory to another. Henry Ford in the war was making planes instead of cars. And so this idea of central planning, that the government could concentrate this planning power in one place, became a new development in management. And it was effective, right? We won both the wars. So it was seen as a great technique. In between those two world wars, we had the New Deal, and the government said the collapse of the economy in the 30s was a crisis that had the same dimensions as war. So they used the same techniques of central planning as they were creating all of their New Deal planning boards and allocation boards and so on like that. And so this war economy planning became something that was highly developed. And then after the war, especially after the Second World War, the people who are running those war boards, many of which had come in from the private sector, went back out and applied that same central planning to business. So it's management compounded. It became a very constraining kind of effect. And we called it strategic planning in the 50s and 60s, but that was the transfer of government planning to private industry planning.
How exactly did this concept of central planning went into the private sector? How did this transition happen?
Yeah, and it was really direct. The war planning and New Deal planning, a lot of those planning boards were the government taking executives and managers and officers from the private sector, pulling them into government, saying, you got to solve this problem for me. You got to solve this production problem. We've got to make more planes, got to make more uniforms, as I said. Help me to do that. And so these private industry executives who had some experience of resource allocation management came into the government, exerted the power of government to implement this planning. And then after the war, they went straight back out to the corporations and the C-suites and applied the same techniques, the same management processes. So we talk in the book about a couple of big examples of that. One was General Electric. So they became famous in the 50s and 60s for their central planning that they called strategic planning. They had so many strategic planning units that the CEO, Reginald Jones, said he couldn't keep up with it. There was so much planning, too much planning. We couldn't keep up with our own plans. And a similar thing happened at IBM, what they called the IBM way, but it was a strategic planning, central control, allocate resources by the center and not by the businesses that were close to the customer. So it was a direct transfer of war planning to private industry planning. And what happens is that the employees at the front line, the ones in touch with the customers, are so far away from these central planning units that the information can't get through. They can't be responsive. And there was also a big time trap. To plan for a fiscal year, you started 12 months in advance or 9 months in advance, and you had to get it all into the documents and the spreadsheets of the time. They weren't quite what we have today, but still the same spreadsheets. And then they have to roll it through the corporation, implement it, get it into the departments, get it into the different layers of the hierarchy. It just takes a lot of time. And so that central planning was undermining customer capitalism directly.
I think I got it. But those post-war American companies, these big corporations, were pretty successful, right? What does your book have to say about that?
Well, yes, they were nominally and for a time. So, especially after the Second World War, America's very dominant. The other great industrial powers are kind to repair, whether that's the UK or Japan or Germany or Russia. The Americans were in much better shape. The war was fought over there, not over here. And so these central planning companies were able to invest in a lot of capital. This is big, fixed, rigid capital, the big factories that I call it bolted to the center of the earth, the paper mills and the steel mills. And to run those very efficiently, so it's all about the length of production runs, the lowering of costs, the number of units that you can produce to get scale efficiencies. And so, yes, they were successful in that sense. The return on that capital was quite high. The companies were profitable. They were exporting all over the world. But it didn't last. It was a short period of time, and it started to erode. One of the great events in that, obviously, was the Japanese eventually building their own automobile manufacturing systems and becoming not only more efficient, but building better quality than the Americans did. So, yes, they were successful for a short time with this big fixed capital investment kind of capitalism, but it didn't last and they weren't able to adapt.
And you told me that apart from that, there was one more big twist that happened that's in your book.
Yeah, there's one more step in the story, Elias, and that's what we call financialization. So we've talked about management, we've talked about production, we've talked about planning. But one of the things that started to happen was the size of the financial sector. So compared with these owner entrepreneurs that we highlighted in the 19th century, used cash flow to build their factory. So we mentioned in the book, Singer Sewing Machine built the biggest manufacturing plant in America in New Jersey to make sewing machines, which were the computers of their time, if you like. They were the big domestic and commercial device that people used. They built another factory about the same size, slightly bigger, in fact, in Scotland, all from cash flow, and they were able to generate dividends as well. So tremendously efficient use of capital. But as time went on, what the managers started to do was to use capital markets, financial markets, to support that early stage of capacity building. So that's the stock market, it's stocks and bonds. Eventually they become derivatives and other secondary products. And you start to create a financial sector, the sector that trades in those financial devices. They don't produce anything, they're not productive, but they're facilitating, they're trading those financial devices. So then what happens is management starts to look to the financial market as opposed to the customer market to determine what is success. So today it's measured by your stock market price, it's measured by the tradability of your bonds. And then in effect, management is starting to operate for a very narrow group, which is stockholders. And in fact, Milton Friedman, in his famous essay in the 1960s, said that's the only purpose of the corporation is to make a profit for shareholders. So this became a mantra called maximizing shareholder value, or MSV. So think about that. We're running these corporations for the financial sector. The financial sector is determining whether they're deemed successful or not. And one of the implications of that is the financial sector wants smoothness. It wants quarterly earnings. So those are short-term demands. It doesn't allow for the kind of experimental and exploratory projects, big projects and new investment that are uncertain, and they might work out successfully, they might not, or they might take longer than expected. These kinds of things are not allowed because you've got to have smooth quarterly earnings. And then the managers made themselves stockholders with stock grants and stock options and so on. And so they became part of this insider dealing, which is rewarding themselves for short-term financial achievements. And a lot of money was shifted out of production and into guiding the stock market. So things like stock buybacks and those kinds of things that we have a lot of detail on. Some companies went to the point that more than 100% of their net earnings went into stock buybacks and dividends. So compare that with the 19th century when Singer Sewing Machine is building factories out of cash flow. Now, companies are buying their stock back out of their net earnings and not building those factories, or at least not investing in the R&D. So that's a big shift, this financialization.
So you're painting a very bleak picture about our current economy where all of these big corporations work this way. My question to you is there any hope that this is going to change or that this may change in the future?
Yeah, I don't want to be too bleak. I'm talking about a decline. We call it the decline and revival of customer capitalism. So this shift towards planning and financialization and management methods and processes, it is a decline. Here's the big hope, Elias, and that is that there are new business models now in the 21st century. And those are the digital business models of Apple and Amazon and Tesla and those kinds of companies. They have direct connection to customers. So instead of their attention being diverted to stock markets, although they still are to some extent, the customer has a direct connection. They can buy or not buy. The feedback loops are really, really fast. And change can come from the outside in, the customer back to the corporation, and from the bottom up, individual customers back to the corporation. And so these business models are fundamentally different than the 20th century business model. And that can drive these companies to be much more responsive, become customer capitalists again. An interesting element of that is that you see these companies now accumulating cash on the balance sheet. People like Apple and Amazon have huge amounts of cash. And in fact, Jeff Bezos, when he was running Amazon, said he wouldn't run it for the stock market. He wouldn't run it for quarterly earnings. He would run it for growth and for investing in the right kind of projects and for innovation. So there's great hope that these new corporations will, through these new business models, return to customer capitalism. And there's another aspect which hasn't quite taken hold yet, but I think it might, and that is that instead of the high liquidity tradable stock market of Wall Street, we might get a new private equity market. So you look at companies like Blackstone, they're investing in private equity, i.e. the shares, they buy companies and the shares are not publicly traded. They're funded by a Blackstone credit, whether it's debt or equity, but it's not publicly traded. And it's what they call patient capital. So you don't have to worry about those quarterly earnings. Let's invest in the right projects. Let's look for a return over a long term. Let's be patient. Let's have high returns, certainly, but let's not have that liquidity trading every day on the stock market. So I think those kinds of new financial methods, that's what's funding our data center building and AI development and those kinds of things. So I think there's hope. We're not sure yet, but there's hope that customer capital will be revived by these new companies and their new business models.
So after seeing both sides of the picture, tell me, Hunter, what is your conclusion? Should we be hopeful or fearful about the future of corporate capitalism?
Yeah, it's uncertain, Elias. I'd say the jury's out. So we just talked about all the positives in these new business models, but there's negative elements. There's value destroying as opposed to value creating elements as well. So we know one of the problems, they collect a lot of personal and individual data. It can be used for social control by those companies directly or by government. So we know that the government's buying a lot of the data that these digital business models generate, and they can use that for censorship. They can use it for any kind of social control. We've got these whole new fields that we don't really understand, like social media, and it makes people yell at each other and get nasty to each other. It's a little bit of social erosion right there. And there's some data about young people, especially young women we read, who are, there's real mental health issues about the effects of social media. So we have to worry about that. The Marxist point of view is they're making us serfs. They're making us work, telling Google where our location is on Google Maps and entering our data into Facebook and ordering on Amazon. That's all data that we're providing. We're not getting paid for it. And so it's a kind of a serfdom in that sense. Or we're what the Marxists would call proles, like your Uber driver who, those returns, those wages are getting driven down and down for more and more work. And it's a tight squeeze. So those kinds of things are worrying. We don't know how they'll work out, but mostly I think it's positive. The life is better. They're creating new convenience. They're creating new quality. Jeff Bezos always said, I've got to deliver faster and better quality and lower price. Otherwise, Amazon will go out of business. So the consumer is driving that kind of transition. So we'll see. I'm an optimist. I'm hopeful. I think these new companies will change the decline that we saw during the 20th century.
Let's hope that you're right, Hunter. But you also told me that you closed your book with a warning.
Well, the warning is if these companies turn out to be negative in all the senses that we talk about, they have what an economist would call monopoly control. The winner-take-all economy. They're very dominant. They're not technologically neutral. They can change technology and point it in a way that we might not all want. We've got all these issues about cyber control and espionage and so on like that. So corporate capitalism in the 19th century was customer capitalism. It was good for everyone, we think. It was good for customers. It was good for companies. There was higher well-being, which is what an economy should be generating, making people feel better. The 21st century was what we call aberrant capitalism. So all the negative changes that we've discussed represent that decline and waste and entropy, and it went in a bad direction. Doesn't mean that some people's lives weren't improved, but the corporation was definitely increasingly tarnished, if you like. And so the true purpose of capitalism, to improve people's lives, gets distorted. It's about shareholder value as opposed to customer value. So if we don't resist those forces of centralization, of financialization, of the short-sighted pursuit of shareholder value, if we let them just distort the course of development, then we're in a negative place. So we've got to reassert the values that underpin the system, the power of free markets, innovation, the potential of business to uplift society and raise all the boats. We've got to acknowledge the threats, but we've got to work to make sure that we generate the positives, the true spirit of capitalism. So I'm a big believer in capitalism. I think everybody wins, but you've got to be aware of the dangers and constantly guard against them.
Absolutely. So is there anything else that you want to touch on? I think that after our talk, I'm really excited to see how your book turned out and actually read it and not hear just about it. So tell me, you have a last message to the people listening to us right now?
Yeah, buy the book. So it's called Aberrant Capitalism, Aberrant Capitalism. The subtitle is The Decline and Revival of Customer Capitalism. You can find it on Amazon, so just search for Aberrant Capitalism. You can find it at hunterhastings.com/aberrant capitalism. It's published by Cambridge University Press, so you can find it on the Cambridge University Press site. I'd really be interested to hear from anybody who reads the book and has some comments on it. We really hope that it will help people understand the positives of capitalism, change those young people's minds and say capitalism is good for everybody, but also to think about what the dangers are in corporatism, as we might call it, and make sure that we avoid those. So please buy it, leave a review on Amazon, and you can always find me at hunterhastings@icloud.com.
Sounds good. Thank you, Hunter.
Good. Thanks, Elias.
This has been another episode of the Value Creators Podcast. Thanks for listening. You can visit thevaluecreators.com for links and resources related to this episode, and check out hunterhastings.com for more content on entrepreneurial business management based on value creation principles.